Let's bring in Stifel chief economist Lindsay Pieggs. Lindsay, it's great to have you back. I was looking at sort of the streets estimates for headline tomorrow, and it's remarkable how concentrated they are in that 8 and, say, 2/10, 3/10 range. What's yours?
We're right in that mix as well. We're looking for 8.2%, which would be down slightly from 8.3, but still a very elevated number. And if we do look at the core measure, as much as it tells us, excluding food and energy, we're looking for the headline to come in just shy of 6%, coming down from 6.2 the month prior. So yes, we are seeing some indications of cooling, but the market is very anxious to call a peak in inflation. And I think that's a bit premature at this point, as we're still seeing conflict overseas, we're still seeing supply chain disruptions, and the Fed hasn't quite choked off the demand side yet.
Right. It's been a couple of weeks where we've seen a lot of signs of disinflation in apparel. We've talked about it in metals, in fertilizer, maybe in chips, maybe in shipping rates. But there's a lot of discussion going into tomorrow about how those things aren't going to move the needle of the index itself, given what's happened to shelter and energy.
Oh, absolutely. So we are seeing some pockets of improvement, that second derivative decline or a slower pace of price appreciation, but we really don't think it's going to be a sizable or meaningful impact on that headline number. And by extension, it's not going to have a meaningful impact for the Fed. The Fed has been very clear that they want to see a very steep downward trajectory in inflation before they're convinced that it's time to pause or slow the pace of policy removal. So tomorrow's number, even with that improvement from 8.3 to 8.2 as we're projecting, that's not going to move the needle for the Fed.
So, Lindsay, it's Steve Grasso. So when you look at the CPI, it's a lagging indicator, number one. So how much information are we really getting there? And number two, can you call a bottom in the market for equity players, not you, for equity players, can they call a bottom in the market until we've seen, up until we've seen the effects of QT on the tightening process?
So your point to the backward-looking nature of the numbers is absolutely correct. In fact, much of the cooling that we saw last month and are likely to continue to see this month may in fact be a reflection of the improvement in the global economy at the start of the year, before Russia invaded Ukraine, before we saw this second, third, and fourth round of lockdowns overseas. And so again, I do think it's premature that the market is calling a peak in inflation or looking to call for a peak inflation, as it's likely that prices will remain very elevated at this level for quite some time, continuing to put downward pressure on consumers and add uncertainty to the marketplace.
Finally, Lindsay, are you seeing, one thing that struck me this week is even with oil at 120 and gas a national average of 5, gasoline demand is just getting started, it appears, for the summer. And I wonder, what's the risk of CPI in the summer months actually taking a meaningful leg higher from where we are right now?
Absolutely, and particularly if demand remains elevated for energy, because right now consumers are still out in the marketplace spending, but obviously higher prices is cutting into the amount that we're taking home. But if consumers are more interested in going on that vacation, driving somewhere this summer, and foregoing purchases elsewhere, what we see is simply a shift in allocation of capital towards that energy component. So not only are prices on the rise, but demand could stay steady or even increase, as we typically see in the summer, at the detriment of other categories, perpetuating, though, that rise in the energy sector in terms of prices.
We'll see what we get in the morning. Lindsay, as always, thanks so much. Good to see you.
Thank you.
Joining us from Stifel today. Bonawyn, does it make you think maybe the table is set for more than 50, maybe 75, maybe a point, maybe an intermediate hike?
Maybe if they hadn't taken 75 off the table. And there was much ado made about why would you remove that from your quiver? You may need that arrow. And I'm with her. And I'll take it a step further. I think peak inflation is a misnomer. It doesn't matter. Doesn't matter. I'll tell you what we have. We have persistently elevated, unactionable inflation, and it's volatile. So the things that we're saying we're getting some puts in now. Okay, so food's a little bit cheaper. Lumber prices, we've gotten some abatement there. But now energy. commodity prices are now much higher. So the Fed is going to need to see a sustained downward trajectory and really be able to wrap their hands around exactly where this is trending towards before they're going to move. I think we're just really trying to reverse and engineer the narrative that we want to hear and make a case for why we want to buy the market. And I just simply think that the rules of engagement have changed. The Fed is in a different position.
Yeah, it's a rolling series of non-synchronized events, war, China, inflation, you name it, that's going to make it hard to time.